Good morning, everyone. This is Pauline Chung with the San Mateo Area Chamber of Commerce. I'm the Director of Communications and Marketing. And this morning we have Steve Hotovec of Barastone Inc. presenting to us. This topic is a very little known topic about a way to access your home wealth. So unlocking the equity in your home without debt. So we're going to learn about home equity agreements that allow the homeowners to access the trapped equity and without the burden of debt, which is the important piece of this. And you do not have to be eligible for reverse mortgages in order to take advantage of the tool that Steve can provide. So I ask that you remain muted. You can type your questions into the chat, and Steve will address your questions at the end of his presentation. So I will turn it over to Steve now. Thank you very much.
Thanks, Pauline, and hello, Mark, and hello, Maria. It's an intimate group, but these are always fun for practice, so thank you. So I always like to start off with, I'll ask a rhetorical question, but if you were to think of the largest asset class in the world, most people, it's not really a question, more of a statement, most people would say stocks or bonds, things like that. But in fact, the largest asset class in the world is residential real estate. As a matter of fact, residential real estate actually dwarfs both the bond market and the stock market combined as a global asset. And what's unique about that is that it is the asset that is probably most near and dear to most people. However, it's the least liquid and the least user-friendly, meaning that normally it can't be fractionalized or bought or sold in any efficient means. So sorry guys, let's see here. Why is this not? Hold on, operator error. Okay, why is it not? Let's try this. Okay. So basically the issue is you have a lot of home wealth. So in the US, you have more than $16 trillion of value of housing stock and $10 trillion of debt. So that basically means that you have $15 trillion of wealth that is not currently being used for anything other than it's just sitting dormant inside of a home. And lending, especially now, even though interest rates are really low, is at an historical all-time or near all-time low. And one of the big reasons for that is that in the 2008 in the financial crisis, what happened is lending restrictions, requirements for debt to income, and the implementation of Dodd-Frank basically stated that there are much more stringent restrictions on lending because of the ability, you have to prove what's called the ability to repay, right? So basically it means that you not only, before you take out a loan, you have to be able to demonstrate that you can pay the interest and the principal back in a timely fashion. So the homeowner's dilemma is that they have all of this wealth that is trapped, but home wealth is actually a non-financial asset. So when you look at it, you take things like stocks, bonds, cash, those can be easily converted into, if they're not cash, they can be converted into cash. Home wealth really can't be used to buy goods or services. So we refer to a lot of homeowners, and everybody that has a home, especially in the Bay Area, are what we call house rich but cash poor. So the homeowner's dilemma is there a way that homeowners could actually convert a portion of this accumulated wealth into cash or cash equivalents, or even convert it into things like current income without having to erode current equity and without having to take on the burden of debt or having to make monthly interest payments? So the solution, these agreements came about probably close to 10 years ago. We have been actively working in this space and sort of pioneers in the non-bank financial arena for the past 5 years. So these agreements, which we generically referred to as home equity agreements, They're sometimes called equity share or equity release, but basically the concept is as follows. The homeowner gets to receive cash today, and that cash is tax deferred. So it's a lump chunk of money that's actually paid to the homeowner. The homeowner maintains the rights and privileges of ownership. So they're not actually giving up any of their rights or privileges. They maintain all of the responsibilities and the privileges of owning the home. And the homeowner and the investor share in either the current and or the future appreciation and or depreciation. So unlike debt, and in the next slide, we're going to talk a little bit about, as Pauline described, one of the best ways to describe what this is what it is not. So what it is not is any form of debt, because in order to this is a real estate transaction and investment, and the investor must be taking risk. It doesn't mean they have to be taking the same level of risk as the homeowner, but there must be risk in the transaction, meaning that there cannot be a guarantee return of the principal and an accrued interest rate. Okay, so unlike all other vehicles, this is an investment that is being made by an institutional investor, and these investors are folks such as family offices, insurance companies, endowments, foundations, and I'll talk a little bit about sort of the top 3 or 4 questions we get asked from homeowners in a minute. But so what are home equity agreements? So like I said just a minute ago, they're not a loan or reverse mortgage. They're not a HELOC. They're not a line of credit. There are no monthly interest payments. There are no interest charges. There is no restriction on how the cash is used, generally speaking. However, if many folks use this to pay off credit card debt or improve financial situations, so in those cases, there may be a requirement to pay down a certain level of a lien. So for example, if someone had a home equity agreement and a mortgage and a home equity line of credit, and they were looking to pay off that credit, or that would be paid off before the homeowner would get to use the excess funds. But generally speaking, there's no restrictions on the cash is used. There's no need for homeowners to tap into their current equity. Many of these agreements basically say, look, I'm going to share in future appreciation, but I'm going to keep and protect all the equity that I have in it today. That's very important because unlike in a reverse mortgage, the only time that this would potentially erode equity is if the house were to go down in value. Okay, so in a reverse mortgage, what happens is the debt and compounding interest gets larger and larger as time goes on and can eventually erode equity. So this is a way for folks to transfer the risk of future appreciation in exchange for cash today. And there is no need to pay off an existing mortgage, which is very important and differentiator from a reverse mortgage. There's some pretty low interest rates right now. So many people are using this to get extra cash, but want to keep their first mortgage at a low interest rate. In a reverse mortgage, it's always required that the reverse is in a first position, and they can't take additional liens on the home. So why enter into a home equity agreement? I always like to say this is for folks that are in one of 2 categories. Homeowners that are either unwilling, meaning that they just don't want debt, they don't want the extra payments, or unable. So that we have done this with transactions. Folks have millions of dollars in savings, maybe $1 million in fully paid for properties, and they just want to take some chips off the table and improve and diversify. So it's for folks that need cash. There always needs to be a cash driver, even if it's just investing or savings. They may be folks that are unable to qualify for a loan. They might be unwilling to take on additional debt. And many of these people invest in other real estate, other properties, or in the business themselves. So home equity agreements have been used to pay down debt, short-term credit repair, diversification, supplement income, college funding, you name it. You can just anything cash can be used for. are. Home improvements and accessory dwelling units, we're seeing a lot of demand, especially during these crazy times for people where, and Pauline and Maria have heard me say it before, but the home's not just the house anymore. It's your school, it's your gym, it's just about everything. And your garage, even, as you can see, is now even other things. Probably the most common source that we see is just life events or comfort cash. People just don't generally have enough money in cash or cash reserves to get through difficult times, and so it helps them sleep well. So how do these equity agreements work? When we first started, and Pauline was one of the first folks that actually heard this 5 years ago. At that point, there was only one provider in the market. We currently have 9 different programs across 22 states. We work with the homeowner to determine one or more programs that could be eligible. Each program has unique characteristics. Some of them might just say, here's 10% of the home's value in exchange for 16% of the future. That would be an example of a 10-year product. There are also programs that go as long as 30 years. So what we like to do is we try to give homeowners a range of options and then stack them up against maybe debt or other liquidity options that might be available. So many of these agreements might say for a 10%, they could range anywhere between 25 to 40% of the future appreciation, depending on the program. And like I said, the terms can be anywhere from 10 years to 30 years. So the application process is really simple. They basically, all of this is done online. So we send a secured portal. Normally the homeowner will contact us and just say, I'm looking for this, what's the need? And we'll ask a couple of basic questions and what they're trying to achieve. And then we'll pre-approve the property to make sure that the program, one or more programs, are available in their area. We pre-qualify, and then it goes through an underwriting process. There's normally an appraisal, just like a refinance, and then there's a funding process. We can do it as quick as 2 weeks, but we generally give guidance that it's going to take 4 to 6 weeks. Especially nowadays, some of the title companies and appraisers are pretty busy. So there's a couple of different case studies, different scenarios where increased cash reserves. We did one with a couple in Los Altos where their home value was $2.9 million. They released $500,000, and they get that money tax deferred. So this is not a taxable event until the agreement is settled, the home is sold, or the last surviving homeowner passes away, or the end of the term. So if it was 30 years later, they could refi out of it or pay it off. These are just a couple of general case studies and examples. So the one last item that I just wanted to say that I normally go through with folks is I normally get asked 3 questions. Number one, it's more of a statement. Number one, this sounds too good to be true. This is like free money. And I always tell people there's no free lunch other than diversification, but it's not free money. What you're doing is you're actually sharing in future appreciation. And many times if folks have already had that $250,000 or $500,000 threshold of net worth, if they were to sell their home, 40% of that proceeds of that house would actually go to taxes, long-term capital gain. So this is a way to actually access some of the wealth now and use it for diversification or other more important needs. It's also, as people accumulate this wealth, they need, as they get older or they have other things that come up in life, they want to convert it to either current cash flow or just things that are more important than having every last dollar tied up in the house. Even after we do these transactions, most of our clients have 50 to 60% of their net worth still tied up in the house. So it's a great step to diversify, but it doesn't necessarily solve the concentration issue. Second question we get asked is, after this is too good to be true, is there has to be a catch. Why would somebody be doing this? And so I actually explain to them that the folks that are at the other end of these transactions, which are financial endowments, foundations, family offices, they are looking to get exposure to residential real estate without all the hassles and headaches of actually owning it. This is a great way for them to get exposure to residential real estate, but they don't have all of the liabilities of maintaining it. That stays with the homeowner. So they're providing liquidity in exchange for the hopeful appreciation and non-correlation, meaning that the exposure to an asset class that is a great inflation hedge for them on an institutional level. And then the third question is, why wouldn't I do this, right? So they sort of say, okay, I see what's in it for both sides. And we normally say, well, it's not normally a short term, although these can be used. Well, that's actually not entirely true, that some of these can be used as short-term bridge financing, but most of the use cases we see is getting a lump chunk of money for a period of 5, 10, I normally say 3 years greater, or 5 years is even better as an optimal amount, because you are getting this lump chunk of money where you can put it to work. You don't have to worry about the interest payments. So why wouldn't you do it? The answer would be there may be other vehicles that make more sense, such as a short-term loan or a bridge financing. The second is, if you're a person that has to feel like they're worried that the house is going to run away in value and it's going to kick themselves later for sharing some part of it, then don't do it. But I always tell the story of, if you had a bunch of wealth in stock, you really wouldn't normally keep it all in one basket in one spot, because there's just too much risk in it. So those are sort of the three things. Sounds too good to be true. What's in it, and why? Who are the people that invest in it, and why wouldn't I want to do this? Are our top three questions. So with that, I've exhausted my 18 minutes to keep in the budget, and I'd love to answer any questions or get feedback from you.
Steve, I think that you've addressed this question in the past, but my understanding is that not every homeowner would actually qualify for your program, right? I mean, there are certain areas where you would not be interested in investing.
So that's changing. So it used to be a much smaller group. So certain metros, even within California, right? So they might not go to a place that either had low appreciation. But now with the 9 different programs that we have in 22 states, they pretty much go anywhere that they're going to a lot more areas. The second part is clarification. We used to only deal with credit scores had to be in the 600 or 630, which is actually not bad, but we can even deal with credit scores as low as 500 or 550, right? So that actually has changed over the past 6 months. And the thinking is that there are many people that they might have gone through bankruptcies, they've lost their business, but they have fully paid for homes and a lot of equity. So those are beginning to change. With that being said, if you have folks in Iowa or Texas, those are states that there are no programs available. So, but in the metro areas, generally they are.
Okay, thank you.
Any other questions for Steve?
I think the other one is, what if, let's say I did it January 1st and something changed in my life and I had to sell my house on July 1st. How would that all work?
Yeah, that's a good question. So one of the things that, as these have evolved, they have put what's called an IRR, or internal rate of return cap. Okay, so normally all of these programs, for example, if I said to you, here's a 10% of your home's value in exchange for sharing in 16% of what the future value of it might be. And then you turned around and I think you're 2 months later, all of a sudden a life event happened and you had to sell the house. And then you're thinking, wait a minute, I just got $100,000 on my $1 million house and I'm going to have to pay $160,000. That seems egregious. So what they've done is they've actually put protective caps for the consumer. So you might have to pay, say, $118,000 or $120,000 back. And I'm assuming that the house hasn't moved, right? Because it's only been a month and these aren't designed. But yes, it would have been expensive, but not egregious. So that's one of the things that all of these programs work with the Consumer Finance Protection Board to make sure that it has to be fair on both sides to accommodate those events. On the other side, it is at your discretion. It's the homeowner that gets to decide when that happens, right? So it has
Mhm.
to be fair, but that's how they're addressed. That's a good question. Comes
Okay.
up quite a bit. Yep.
Any other questions for Steve?
Good morning. I would actually appreciate, Steve, I appreciate when you talk about it, but I'm more visual person than audio. Can you bring up again one of your example that you put through your presentation? It was an example how like the house, I don't know, 2 million, yeah. So
Was it one of these? Yeah.
right. Can you explain again this home improvement? Like, for example, I don't know. I still don't understand in terms of like, I'm borrowing 10% of my equity in exchange for 16% in 10 or whatever, 20, 30 years that I have to pay it back. I'm not sure how this terms of 10, 20, 30, how does it work?
Yeah, so these are one of the challenges of these products. It used to be one example because we only had one program. Now there's different scenarios, but to keep it very simple in one example, it doesn't mean that this is the only example. But if you had let's say that you wanted to put an accessory dwelling unit onto a home. And you needed, let's just say you needed $200,000 or $150,000, and let's just say that your home, let's say it was $150,000, and your house is worth 1.5 million. You would get the $150,000. You would pay for the accessory dwelling unit straight out, okay? If you used all the proceeds, and then the investor is going to participate in, say, 16 or 17% of the value of the home, okay? Whether it's in 3 years or whether it's in 10 years, okay? So if the home value goes up as a result of it, the homeowner and the investor make money together. If the property value declines in value, in 10 years, the agreement is due. So you either are going to refinance it, or you're going to pay it off, or you're going to sell the home. So you basically have a couple of choices, but for 10 years, you have a fully paid for accessory dwelling unit that you could rent out. You could generate cash flow and do whatever you like.
What do you mean in terms of sell the house? Meaning, well, no, not that sell the house, refinance. How does that help me?
Yeah, so they can be purchased out. Well, the term, so it's no different than it's not a loan, but that's in this example, that is the term where it would be due. If it were something where that's too soon and there was no intent, then you would do a 30-year program, right? But these contracts come due at the earlier of when the home is sold. Oh, by the way, you could move out and rent it. You don't have to stay in the home, right? So you could rent this out, but at the end, the contract terminates at the end of the term when the home is sold or the last surviving homeowner passes away, whichever of those three events happens first. At any point during the term, you could elect to refinance, pay it off, buy it out early. They would just do an appraisal and you would settle it that way. So it's the homeowner's choice, but that's how the agreements read.
So if I borrow $100,000 through this agreement for 10 years, and 10 years comes up, at that time I have the choice of refinancing for that amount that I owe, which is $100,000 plus interest.
Well, it's the value of the home. So an appraisal is done in the beginning, and then we would say, okay, Maria, what's the value? And this is how much it's due. If the house went up, it's worth a lot. It's worth more. If it's not, then it could be worth less, right? The amount that is due could be less than what you received. Now, you could roll it into another agreement, or you could refinance it, or you could sell the home.
Okay.
I still have, sorry, Maria have a good example, like, okay, borrowing $100,000, which is a 10%, let's say, in 10 years, like you said, in 10 years, the term is up, I have to give back $160,000. So if I refinance the house, I have to add that amount to my refinance loan to give back that money in case I don't have cash to give back or whatever. I don't have that money. So refinancing, like for example, when I'm borrowing the money, let's say I owe to pay for the house, I don't know, $500,000. And then in 10 years, if I don't have those 100 that I borrowed to pay back, I have to refinance and make the, not 500, but basically plus 160 to receive them in cash from a refinance. And now I start paying much more. Like that?
Right, or you could go into another agreement. It's the same thing with a loan, right? If you think about a balloon payment on a loan, it's sort of like that. But if your house didn't go up in value, right, it's not going to be worth more. The agreement is it's possible that it could be lower in value, right? So, but you understood it correctly. At the end, at the end of the term, one of those events has to happen.
Mm-hmm.
And just so I'm clear, I think we're a little bit off here, but if I purchase, let's just say my house is worth $100,000 or $1 million, which it is, and I borrow 10% for 16% of the future value, in 10 years, if it's worth $2 million, I owe $320,000 to you, correct?
That's correct.
Yeah. Okay.
And your house would have appreciated,
Correct.
And you would have kept the lion's share of that appreciation.
Right. I would have given.
Conversely, if your house went in down, okay. Yeah. So when you look at what's happened, real estate in the Bay Area has gone up 10% a year every year for the last 10 years. That's unlikely and probably unsustainable. But I don't want to argue with people because these are folks that wouldn't do it. They're like, well, I think it's just going to keep going up. It's like, okay, well, but you can't do anything with it. And right. You're paying this back with 60-cent dollars. Okay. So at the end, if you ended up owing, Mark, in your case, $320,000, you would actually have a long-term capital loss, okay, of the difference between what you received and what you paid. So you would have a $260,000 deduction, okay, against your long-term capital gain of your home. If you didn't sell the house, but you unwound the transaction, you would be able to take that $260,000 long-term capital loss and offset it against other sales that you might have done and other things if you had them, okay. Or it carries forward.
Yeah.
Yep.
Okay. Makes perfect sense. Yeah.
Yeah, I didn't want to get into the weeds. There's several levels of this, but he's trying to keep it simple.
So Steve, would you advise that when somebody is going into one of these agreements that they bring in their accountant or CPA to, kind of help them understand the dynamics of it?
They always do, and we encourage that very much. In case number, the first one that I had, increased savings and cash reserve, this couple was in Los Altos, and they brought it to their attorney, who was in Redwood Shores, and the Redwood Shores attorney said, "Don't do this." And then he looked at it, and I said, "I'll walk you through the agreement." Walked it through it. Took me probably a month and a half, and then he said, "I think I'm comfortable with it. I understand it now. I just have one question. I was talking to my wife about it. Do you guys do condos in Redwood Shores?" So we actually did a transaction on their attorney. But it's only until they get comfortable with it and can see the agreements and that the protections are fair. That's where we get almost all of our business right now. It's just referrals from folks.
Your second case study looks very familiar to me.
Yes, you might know of that one. Yes.
Yeah, okay. Yep.
Well, and the other question I would have is, do you do this on commercial real estate too, or just residential?
No, we cannot do commercial. We do it residential rental properties. So there's a lot of folks that want to leverage the cash flow, and we can do up to a fourplex, but not,
One last question, Steve. There has to be a dwelling on the property, right? Or can it be just land?
Yeah, no, it has to be. That's a good your own question, sort of. But yes, there's got to be a structure. The other thing that we're playing with accessory dwelling units is putting a cap on it for the homeowner. So we'll give them credit for the money that they put back into the house, because there's going to be an improvement in the property. So it actually looks, it's very helpful, because they're very difficult to get ADU financing, right? So.
Yeah.
Yep.
Okay.
Okay, this was wonderful. Thank you for the conversation with all the participants, and thank you so much, Steve, for presenting.
All right. Thank
yeah.
you, Pauline. Thanks for the invite. Thanks, everyone. Good questions.
All right.
Thank you, Steve.